Every major financial crash in the last 100 years has followed the exact same mathematical pattern. It's not similar patterns, the same pattern. The Great Crash of 1929 followed it perfectly. Black Monday in 1987 followed it. The dot-com bust of 2000 followed it. The Great Financial Crisis of 2008 followed it. It is a distinct five-stage sequence that appears in the data months, sometimes years, before the actual collapse takes place. Wall Street knows about this pattern. The Federal Reserve knows about it. The private family offices that manage money for billionaires definitely know about it. But you have probably never heard of it, and that is by design. Because if regular people understood what to look for, they would pull their money out before the crash happens, leaving the elites holding the bag. Instead, the public is always the last to know and the first to lose everything. Today, I'm going to walk you through all 5 stages of this terminal sequence. And I'm going to show you exactly where we are in that timeline right now. Spoiler alert. Once the debt is maximized and the market is concentrated, we enter stage 3, the smart money exit. This is the stage that makes me the angriest as an economic historian, because it reveals how the game is actually rigged. Before every major crash, there is a distinctive period where institutional investors, the banks, the hedge funds, the family offices, the billionaires quietly reduce their exposure. They sell their positions into the rally. They raise cash. They buy insurance against a crash. But here's the catch. They don't announce it. They don't warn you. In fact, their public statements often say the exact opposite. They go on television and tell you to stay the course. They tell you fundamentals are strong. They tell you not to panic. And while they are saying that into the camera, they are selling their shares to you. In 1929, the Morgan and Rockefeller families started liquidating their portfolios in the summer months before the October crash. Bernard Baruch, one of the richest men in America at the time, was almost entirely in cash by September. Joseph Kennedy famously sold everything after a shoeshine boy gave him stock tips, realizing the market was overheated. But the real reason he sold was that he had deep connections to the banking elite who told him the credit lines were being pulled. Regular Americans kept buying all the way down. They served as the exit liquidity for the smart money. In 2007, it was the same story. Hedge funds started shorting subprime mortgages a full year before the collapse. Goldman Sachs famously bet against the very same toxic securities they were selling to their own clients. Executives at Countrywide and other mortgage lenders were dumping their personal stock while telling shareholders everything was fine. Now, let's look at the data today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, and board members, the people who actually see the daily sales numbers and know what is happening inside these companies, are selling their own stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every one insider buying shares of their own company, there are multiple insiders selling. Meanwhile, retail investors, regular people, have been pouring money into the market. Robinhood accounts, 401k contributions, and passive index flows are at record highs. The smart money is selling. The regular people are buying. This is not a coincidence. This is the pattern. This is how wealth is transferred from the middle class to the ultra-wealthy every single cycle. Stage 3 is not just active. It is in its final phase. This brings us to stage 4, the liquidity illusion. This is the sneakiest stage because, on the surface, everything still looks normal. Prices are stable or even rising. Trading volumes are healthy. Nothing seems broken. But underneath the surface, the liquidity that supports the market is draining away. Liquidity is like oxygen for financial markets. And there is plenty of it. Everything functions smoothly. Buyers and sellers can transact easily, and shocks get absorbed. But when liquidity disappears, markets stop functioning. Prices don't just decline, they gap down. Small sell orders move prices by huge amounts because there are no buyers at the current level. The crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions to try to cool off stock market speculation. What they actually did was drain the liquidity that was keeping the system alive. For a while, nothing happened. The market even kept rising, leading people to believe that the Fed's tightening didn't matter.
Ow.
When the selling started, there was nobody on the other side of the trade. The bids just vanished. Stocks went into free fall because there was literally no money available to buy them. 2008, we saw the exact same dynamic. The Fed had been raising rates, credit conditions were tightening, but the stock market stayed high, and housing prices seemed robust. Then Bear Stearns collapsed, then Lehman Brothers. Suddenly everyone realized the liquidity was gone. The market dropped 50% in a matter of months. Now look at the current landscape. The Federal Reserve has raised interest rates at the fastest pace in 40 years. They have gone from near zero to over 5% in less than 2 years. Simultaneously, they have been running quantitative tightening, pulling hundreds of billions of dollars out of the financial system every month. And yet, the stock market is near all-time highs. People think this means the tightening doesn't matter. They think we have achieved the mythical soft landing. They are wrong. The stress is already showing in the cracks. In March 2023, 3 major U.S. banks failed, in a single weak Silicon Valley Bank, Signature Bank, and First Republic. These weren't small institutions. They were some of the largest failures in history. They failed because of a liquidity crisis caused by rising rates. The Fed had to step in with emergency lending programs, essentially printing money to backstop the banking system while claiming they weren't doing a bailout. But those emergency programs are temporary patches. They don't fix the underlying problem. They just delay the reckoning. The Treasury market, the foundation of the entire global financial system, has been showing signs of severe stress. There have been moments where liquidity in U.S. government bonds nearly evaporated. When the most liquid market in the world starts having plumbing problems, you know the pipes are about to burst. This is stage 4. Everything looks calm on the surface, but underneath, the oxygen is being sucked out of the room. And that brings us to the final phase. Stage 5. The trigger. This is the one nobody can predict, and that is exactly what makes it so dangerous. Stage 5 is the event that turns a vulnerable market into a collapsing market. It is the match that lights the fuse. Here's what most people get wrong about triggers. They think the trigger causes the crash. It doesn't. The crash is caused by stages 1 through 4. The debt, concentration, the smart money exit, and the liquidity drain. Those create the conditions for collapse. The trigger just determines the specific day it begins. In 1929, the trigger was the Hattrey case. Clarence Hattrey was a British financier who was arrested for fraud in September. Nobody in America cared. It seemed completely irrelevant to U.S. stocks. But British banks had exposure to Hattrey's fraud. They had to raise cash desperately. So, they sold their most liquid assets, their American stocks. That selling created more selling, and within weeks, the U.S. market was in freefall. A minor British fraud case triggered the Great Depression. Not because the fraud mattered globally, but because the system was so fragile that any shock would have brought it down. In 2008, the trigger was Lehman Brothers. But it could have been Bear Stearns, or AIG, or any number of other insolvent institutions. The system was primed to explode. Lehman was just the spark that happened to land in the powder keg. So what is the trigger going to be this time? I don't know. Nobody knows. That is the nature of triggers. It could be geopolitical, a sudden escalation in Taiwan, an unexpected expansion of war in the Middle East, or a miscalculation with Russia. It could be financial, a major hedge fund blowing up, a sovereign debt crisis in Europe or Japan, or a derivatives accident. Remember, the derivatives market represents over $600 trillion in notional value. One major counterparty failure could cascade through the entire global system in hours. It could be something in the banking system, more regional banks failing, a run on a major institution, or a crisis in commercial real estate, taking down the lenders who financed empty office towers. It could be political, a constitutional crisis, a debt ceiling standoff that actually results in a technical default, or a sudden loss of confidence in the US dollar. Or it could be something nobody is talking about at all. That is usually how it works. The trigger is never the thing everyone is watching on the news. It is the thing nobody sees coming until it is too late. What I do know is this. When stages 1 through 4 are all flashing red, the trigger usually arrives within 12 to 24 months. We have had 4 stages confirmed since late 2024. That puts the mathematical window for the crash somewhere in late 2025 or early 2026. Now, let me be very clear about what this does not mean. I am not telling you the market is guaranteed to crash tomorrow morning. Timing the exact top is impossible. Markets can stay irrational longer than you can stay solvent. Anyone who tells you they know the exact date and time of the crash is lying to you. I am also not telling you to sell everything you own and hide in a bunker. That is not a strategy. That is panic. What I am telling you is that the specific conditions which preceded every major financial collapse in the last century are present right now. All 5 stages are either active or imminent. This is not normal. This is not a drill. The question isn't whether you believe me. The question is, what are you going to do with this information? Roger Babson didn't just predict the 1929 crash. He prepared for it. While everyone else was leveraged to the hilt, he held cash. While everyone else bought stocks at the top, he bought farmland and hard assets. When the crash came, he was positioned not just to survive, but to thrive. Irving Fisher, the genius economist who mocked Babson, lost everything. His fortune, his reputation, his legacy gone. He spent the rest of his life trying to recover and never did. The difference between them wasn't intelligence. Fisher was probably smarter in an academic sense. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself for what was coming instead of what he wished would happen. You have the same choice right now. You can look at the data I just showed you and decide it doesn't apply to you. You can tell yourself that markets always recover eventually, and that this time is different. Or you can ask yourself some uncomfortable questions. How much of your wealth is in the stock market right now? Not just your brokerage account, but your retirement accounts, your pension, your home equity. How much of that is concentrated in just a handful of mega-cap tech stocks? How much of your financial security depends on prices staying where they are or going higher? If the market dropped 50% over the next 18 months, which is exactly what happened in 2008, would you be okay? Would you lose your retirement? Would you have to delay your plans by a decade? I am not telling you what to do. I am not a financial advisor. I am the economic historian. I study the past to understand the present, and the pattern is clear. The people who get destroyed in crashes aren't stupid. They are just unprepared. They trust the experts who tell them everything is fine. They believe the system is more stable than it actually is. They assume someone would warn them if something was really wrong. Nobody warned them in 1929. Nobody warned them in 2008. And nobody is going to warn you now. The warning is the pattern itself. And now, you know it. What you do next is up to you. If this video helped you see something you didn't see before, subscribe to the Economic Historian and turn on notifications. I'm going to be breaking down each of these 5 stages in more detail over the coming weeks, including the specific data points you can track yourself to see the crash coming in real time. Knowledge isn't power. Applied knowledge is power. The crash of 1929 didn't have to destroy so many lives. The signals were there. The pattern was clear. People chose not to see it. Don't make the same choice. This is the Economic Historian signing off.